Okay, I wanted to talk to you guys today about what I do in regards to purchasing stock. I spoke to someone on yesterday, and they had informed me that they didn't know how, to even begin to purchase stock. They didn't know anything about that, and I was telling them, some of the things that I did to get me into this position and things that I've used along the way that allowed me to be able to purchase these stocks. So I kind of wanted to give that information today and just show you things that I do. This is not at all financial advice. In no way, shape, form, or fashion will this be provided as legal advice or any advice other than the fact that this is something that I do, and you're more than welcome to look into the information and make decisions based on yourself. First, I'm going to talk about, a guide to buying stocks without a broker. This is what I do. I don't use a broker. Since 2005, 2006, based on the market, you really realize that some of these brokers actually don't know what they are doing, and they're using your money, and it's a gamble for you because they don't understand what they're doing as well. So I learned, starting with the 401k, I opted out of my 401k to have the broker invest the stocks, and I started doing it myself, and I started realizing that I made a better return when I opted out doing it myself, and at that time I had no earthly idea of what I was doing. So some of the information I give you today is just some information that you can look up and see what is the best choice, if that's something that you would like to do. But this is what I do currently up until today. So let's get into the fact that dividends, what they are and how they are accumulated, and how they begin to be structured from a company. The decision to initiate the dividend increase or decrease is a firm's cash dividend is an important decision that is made by the firm's board of directors. The board relies on the input of the management team to make the right decisions. When the board is considering an increase in the firm's dividend payout, a prime consideration is whether the dividend payment is sustainable. If that's something that they can continually do, then they would do that. They don't want to increase the dividend today if it's in all likelihood that it will have to cut the dividend in the near future. So they would only cut dividends if it is clear that the higher current payout is no longer sustainable. The latter is most likely to occur in the midst of a recession or something like that. Keep in mind, a dividend is also called a income producing stock. So these are stocks that produce income, because they do in fact produce income. Every 3 months you receive money based on how many shares that you have, and your dividend payout is a percentage of that particular share that you do have. And you can accumulate a substantial amount of money based on how many shares that you have. So you do get paid. You get a check 4 times every year. So you got to keep that in mind. The fraction of the firm's earnings is paid in dividends. And that is called the dividend payout ratio, which indicates the amount of dividends paid relative to the company's earnings. For example, if the dividend per share is $2 and the earnings per share is $4, the payout ratio is 50%. So, and in regards to, we're going to talk about the tax rate as well, because this is something that I had to find out before I even begin to invest in these things. Is I need to find out how and who can take money from me any which way. That way I'll know how to protect my money and my assets. So dealing with the tax information, this is something that you need to know also. There are certain things that you need to know that will help you protect your assets, because this is what this is all about. The maximum tax rate on dividends and long-term capital gains which long-term capital gains are stocks that are held for more than 1 year or longer. It was lowered to 15% for most people. And in order to qualify for the lower taxes on dividends, you're required to hold the stock on which the dividends are paid for more than 60 days. So as long as you hold it for more than 60 days, you're fine. Now, what happens here is during the 60 days, 120 days period that begins 60 days before the ex-dividend date. The ex-dividend date is a date that they require for you to have that stock already in order for them to pay you. So that's basically your get-in date. If you have stocks by this particular day, then that's your ex-dividend date, and you'll get paid based on that particular day. Dividends paid based on that day. So as long as you've purchased the stock within that dividend date, you'll get paid from that dividend date. So 120 days period that begins 60 days before the ex-dividend date. If you do not meet these qualifications, the dividends are taxed like ordinary income. Ordinary income tax rate is about 70%, and the capital gains rate is about 35%. And that rate is for those who do not hold stocks for longer than a year before they decide to sell it. So if you get a stock and you purchase it and you don't hold it for a year, then you'll be taxed at those rates. These are some tax facts that I needed to know, and I'm going to pass this information on to you, and it could be helpful for you, because if you listen to these facts, you'll find out how, in fact, you're able to protect your assets and allow these dividends to work for you. That's what I've done. I allowed them to work for me by using these tax facts. Concerning dividends and stock repurchases, the fact number one is that 100% of cash dividends received by individuals are taxable in the same year in which they are received. So if you get a dividend this year, of course you're going to have to pay taxes this year on that dividend. Fact number two, don't go anywhere because this information is valuable. Facts number two, when a person sells stock or shares of stock, the only part of the cash payment that is taxable is the gain in price over the original price that was paid for the shares. Now, if you sell shares for $20 that you bought for $18, then you would have to pay taxes only on the gain of $2. So, not the $20. And I wanted to make that clear. Fact number three, if a person decides not to sell his shares back to the company, making a stock repurchase, if you repurchase the stock, you will not incur a taxable gain from that transaction because the investor did not sell. So if you receive a dividend like I do, I receive a dividend and I don't sell the stock, I reinvest that dividend. I don't take that dividend back, I reinvest it into buying more shares. Therefore, I'm not charged taxes because I never sold. I'm just using this as a snowball effect to purchase more stocks. And this is how you can accumulate wealth, by continuing to do this over and over and over again for a long-term effect. If you have young children, like my children, I have them in the DRIPS program or dividend and reinvestment programs. They continue to purchase stock through the dividend, and they're not charged taxes, or I'm not charged taxes. So therefore, it's a snowball effect, and when they get a certain age, they'll have a certain amount of shares, and they'll just be basically paying for themselves. The shares are paid for themselves through the reinvestment program. So, this is the fact. It's easy. You did not sell, so you don't get charged anything. In the same instance, the investor defers the tax that might eventually have to be paid on his gains in shares. Eventually, when you do sell the shares, you will pay taxes, but there will be a value in being able to defer those taxes into the future. Now, this is principle one of finance and money. Remember that money has a time value, which tells you that pushing a cash expenditure such as taxes further out into the future reduces the present value. And that's what you want to do. You want to, in any shape, form, or fashion, you want to kind of reduce the present value of the cash that you have to pay taxes on. If you logically think about this, this makes sense. So you can use this to advance. So if you reinvested the dividend to purchase more stock, you won't have to pay taxes on the dividend. Not only that, but if the stock that you obtained from the reinvestment dividend was sold by you at the same price that they were paid for, you would not have to pay capital gains taxes. So it's basically would be free money that you dodged paying taxes on. And I'm gonna repeat that for you. So if you did purchase stock at the same price that you paid for them, you would not have to pay capital gains on the taxes. So it's basically, it would be free money for you. So this strategy beats taking the cash dividend payment that you have to pay on taxes, plus you can get compound interest. Compound interest is very valuable. It's a very valuable sum that you get compound interest, and you can use that to your benefit. You can also take the dividend payment later in retirement, which gives you your stocks a chance to snowball to a huge nest egg. And that's what you want to do right now, is kind of build you a nest egg. So the repurchase plan is better regardless of whether you sell the shares back to the company or keep them, because they don't incur any taxes. Whereas if you receive the dividends, you would have to pay taxes on them. Also, by reinvesting the dividend for more shares, you avoid brokerage fees for buying stock. Each time you trade and sell stock, you have to pay a brokerage fee. And currently where I'm at right now, it's $4.99, and that's very inexpensive. Each time I sell a stock, I have to pay $4.99. Each time I buy a stock, I have to pay $4.99. Coming and going, I have to pay $4.99. So if you are not selling your stocks, you don't pay dividend. You don't pay brokerage dividend fees. And you're allowing your money to snowball, build up into a great nest egg, and using compound interest to help build your wealth for you and your children. This is a very valuable tool that I'm providing for you guys, that I let you know just what it is that I'm doing. So because firms with different dividends attract different dividend clientele, these are groups of investors who prefer the firm's cash distribution policy. It is important that the dividend policy remains somewhat stable. For example, a retired person who bought a company for its steady improving dividend might be disappointed if that firm stopped paying dividends. Likewise, if shareholders might be unhappy if a company decided to suddenly start paying high dividends, exposing them to tax liabilities that they might not have planned on. So dividends is pretty much a stable environment, and that's what most investors or shareholders are looking for. Something stable that they know basically how they can structure building their nest egg and don't have any surprises that come up on them. So investors in stocks, and pretty much stock analysts, are constantly trying to decipher the information released by firms to better understand what it is that implies about the firm's values. This is a reflection different things that they do. Like I said, there's a lot of analysts and a lot of people that brokers who have absolutely no idea what's happening, especially in today's cycle. They don't understand things change, and you can't use the formulations that you used before basically to figure out what's happening right now. Sometimes you can and sometimes you can't, but that is a gamble that you will take with someone who may not be experienced. And the whole thing is to be able to help myself and yourself be able to protect your assets, protect your money, that because it doesn't make sense to leave your future and your retirement up to somebody else who has no earthly idea how your life is, how your life is structured. They don't know anything about you, but they have an opportunity to play with your funds. Makes absolutely no sense to me, and that's why I don't invest that way. Like I said, this is not advice. This is only something, I'm just giving you an example of things that I'm doing and why I'm doing it, and giving you an understanding of the world that I live in at the moment. Now, increasing the dividend is a good sign. Repurchase of shares are also good. If a company repurchase those, it's good because it shows that a firm has more money than it needs. A cash payout is much easier to interpret than an accounting statement, which can be misleading. When the firms buy back their own shares, they are making a bet that they would rather repurchase shares when the shares are underpriced versus overpriced. So, a share repurchase announcement implies that the firm has plenty of cash on hand and that is a good time to repurchase the equity. The equity is also considered stock. So, when a firm announces a repurchase or a dividend increase, the stock tends to rise. The stock price declines when a firm cut dividends or announces that the stock dividends and splits. It means that the firm doesn't have cash flow and determines that the firm's value. I can tell you for a fact I had this particular shipping company, and it consistently did stock splits, and it split so many times to the value of that stock was nothing. Now keep in mind you, this was not a dividend stock that I had repurchased. It didn't pay any dividend. It was a stock that I had just purchased, a regular stock, and it just did splits and split. It didn't have a dividend. So, and that's another thing. Not all stocks have dividends. Some people look to purchase stocks basically on the dividends. Whatever the dividend, some people, those are income investors who are looking to make money strictly off of dividends. So you got to keep that in mind as well. So this is for every type of season that you are using for your own retirement, and that's what I had to do. Whatever fits my lifestyle, that's how I plan to invest, and those are the things that I do. If I'm looking for income, I pick certain stocks that will provide me income. I could care less whether the stock goes up or goes down as long as the dividend remains the same. I'm going to continuously get that amount of money based on the shares that I have. Now, 3 sources of companies offering DRIPs. So they are companies that will provide you the information on DRIPs. If you need that information, all you would have to do is just contact me, email me, send me an email, give me a likes up, and tell me the information that you will be interested in receiving the information, and I'll go ahead and send that to you. I can send you a booklet. I can send you the information so you can order the booklet. That way you can purchase your dividend reinvestment stocks. So this is a booklet that has to do with nothing but you purchasing stocks that will pay you dividends. So it's easy and self-explanatory. So if you would like that information, just send me your information, and I'll go ahead and send you that information so you can obtain that for you. So I'll send you that information for free so you can order the book on your own. So there's 5 basic principles to financing. Money has, first of all, the first principle is that money has a time value. A dollar received today is more valuable than a dollar received a year from now. Keep that in mind. We can invest the dollar we have today to earn interest, so that at the end of the year, we will have to pay more than $1. Because we can earn interest on the money received today, it is better to receive money sooner rather than later. Now, this is also a money principle. There is a risk and a return trade-off. We won't take an additional risk unless we expect to be compensated with additional returns. The next one that is very important to me is that cash flows are the source of value. Profit is an accounting concept designed to measure a business performance over the interval of time. Pretty much, cash flow is the amount of cash that can actually be taken out of the business over this same period of time. Accounting teaches that a company's profits can differ dramatically from a cash flow. Cash flow represents money that can be spent, and this determines an investment value. And you got to keep that in mind. Money that can be spent, profits are different. Now, to determine a company's accounting profits, its accountants have to make a judgment about how the business costs and revenues are allocated to each time period. Consequently, different judgments result in different profit measurements. In fact, a firm can show a profit on paper even when it is generating no cash at all. This is something that you have to keep in mind. Profits are important to some investors because it is an indicator of a firm's past and future ability to produce cash for investors. So profits affect investors' expectations. Remember, the expectations is very big when you're dealing with this investment world and you're dealing with equities, aka stocks. So my fourth principle that I like is that market rises reflect information. So investors respond to new information by buying and selling their investments. The speed with which investors act and the way that the prices respond to the information determines efficiency of the market. That's just like if Donald Trump come out and say something that makes no sense to the world of finance. It makes investors kind of leery, and they do not want to be in an environment that is not safe for them, so they start pulling their money out. And you see the stock market may crash for that day, or he may say something good, and to investors that they feel safe, and you might see the market rise that day. It could go either way. When earnings reports come out, prices adjust immediately to the new information, moving upward if the information was better than expected. That word expected is very important. And downward if it was worse than expected. Expected, very important words. And this makes a whole lot of difference on whether the stock price changes up or down. And this is something that every investor needs to know. Dividends basically is a double taxation of earnings. When a corporation earns a profit, it pays taxes on the profit, and it pays the same of the profit back to the shareholders in the form of dividends. Then the shareholders pay personal income or taxes on those dividends. Since 2003, basically, the tax law pretty much qualified dividends from domestic corporations, and qualified foreign corporations are taxed at a maximum rate of 15%. If you are in the 10% or 15% rate bracket, your taxes on dividends drop to 0%. I remember in 2013 when President Obama signed into law the American Taxpayer Relief Act of 2012. This kind of reduced the tax rate on dividends income for all but those who were at the highest tax bracket, and raised the tax rate on qualified dividends from 15% to 20% for individuals with taxable incomes over $450,000. And that was married filing joint, and $400,000 for individuals who are unmarried. Based on the new tax law that came out, I believe that may have been some changes, and you probably have to look. I know for a fact there's been some changes, but in regards to the number amount, you'll have to look into that. A corporation that owns less than 20% of the stock in another company can exclude 70% of the dividends received from its taxable income. When between 20 and 70% of the stock of another company is owned, 75% of the dividends received from that firm can be excluded from taxation. Just like also when 80% or more of another company's stock is owned, then all of the dividends received from that firm can be excluded from taxation as well. Now, there's a big thing in cash flow. Earnings seasons will start sweeping all over Wall Street about July 20th. And with each report, the focus would be on two numbers: the company's earnings and their sales. That pair dominates investors' attention. After all, basically, they are the most important figures in any quarter report. How much was sold and how much profit was made. This is simple, guys. This is something that you deal with every day. How much is sold and how much profit was made. But investors should also look at the company's cash flow and often understand sets of numbers to earnings report. Cash flow describes how much cash goes in and out of a business. Earnings and revenue figures are seldom straightforward. A number of factors can screw results, such as the number of days in a quarter or extraordinary expenses. When a manufacturer takes an order for $10 million in merchandise, it may not get all that money until months later as deliveries are made, yet it may recognize the entire value of the contract right away. So cash flow accounts for all changes in cash in or out a reporting period, and that can provide a more transparent look at the conditions of a business at that moment. For growth companies, look for cash flows per share, at least 20% higher than earnings per share. Historically, that has been a level since most winning stocks. You can find the cash flow in the quarterly earnings. Operating cash flows are the first listed. To find cash flow per share, take the total net cost provided by operating activities and divide the sum by the number of shares outstanding to get the cash flow per share. So, just starting out, just that information. Always remember, we'll just put that information out there for you. But always remember this: money cometh gladly in increasingly quantities to any man who will put by no less than 1/10 of his earnings to create an estate for his future, and that for his family. That's the only way to acquire wealth, is to save. Money labored diligently and contently for the wise owner of it, who finds it a profitable employment, multiplying even as the flocks of the field. Invest your savings. Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. So remember that. Compound interest is very important. He who understands it earns it, and he who doesn't pays it. That is a quote from Albert Einstein. Now, money clingeth to the protection of the cautious owner who invested under the advice of men, wise men who handle it. So, if you can trust or find any wise men to handle your money, then you're in good faith. Also, money slippeth away from the man who invested in business or purposes with which he is not familiar, or which he is not approved by those who are skilled in this step. So it also, money flees the man who would force it to impossible earnings, or who will follow it alluring advice of tricksters and schemers, or those he can't trust in his own inexperience and romantic desires in investment. Basically, what I'm saying, if it seems too good to be true, then it probably is. So that's something that you guys may want to think about. A part of what I've earned is mine to keep. Every dollar is a dollar saved, is a dollar that you can use to work for you. And each dollar that you accumulate, you can use those dollars to accumulate more dollars to work for you. So, opportunity is a hotly goddess who wastes no time with those who are unprepared. So make sure you're studying and you're understanding the information that you're getting, and you understand different type of investment vehicles that you're using to profit from. Make sure you're studying. There's too many people out here trying to take money from us at the cost of us wanting just to build a great nest egg, do the right things for our family, and people know that becomes vulnerable. You become vulnerable to other people, and they like to take advantage of you because they understand what it is that you're trying to do, and they make it sound good, like they can help you get to it. Most information, if someone's trying to help you, information that they'll give you, of course, there's some information that's good information and you have to pay for it, because those people understand that information is good. But people that try to help you, they will provide you great information for free. And the only thing they ask you to do is just check on the information to make sure it's correct. So a lot of times people pass up their opportunities because they're lazy and they don't want to look or listen to the information somebody's trying to provide them. And that person is in essence trying to help them. But they're not going to break their back to try to help you and give you some information that they know can help you, and you don't want to take the time to help yourself. So hopefully we've been helpful for you today. Thank you very much for listening to us. If you need any of the information, just send us a reply and we'll provide that information for you. That way you can get that information, and we won't charge you anything. We'll just give you the information that you need so you can purchase the booklets yourself. So, but we will gather the information for you. So, thank you for listening to us, and we hope that you have a pleasure.